You know, in trading securities, there's prices out there. To buy, they're called bids, and to sell, they're called asks. And, regardless of the type of security, and we'll look at those, they are arranged in a decreasing order, of course. And if you're a buyer, you're buying it from a seller above here. And if you're a seller, you're selling it to a buyer below here. And the innermost difference is called the spread. Now, you won't normally see this information as such. You'll just see the lowest ask price, and maybe with the size, meaning the number of securities. And likewise, you'll see the uppermost bid price, and again, maybe with the number of securities. The spread can be wide for illiquid, not frequently traded securities, often the case of bonds and options, and can be very narrow, literally down to pennies, in the case of commonly traded stocks. These are available on listed exchanges and sometimes on over-the-counter or NASDAQ, meaning there's not always a buyer and a seller. A good strategy, although not always successful, is to think of it as though you're dipping your toe into the water. The waves may come in or out, or maybe you'll have to wade further in. If the spread is wide and you're buying, well, somebody may be in front of you, so you get in front of them by raising your price. Likewise, if you're selling, you want to get in front of them, so to speak, by lowering your price. And you may have to do that again and again and again. Common shares and ETFs, exchange-traded funds, typically mutual funds and indexes which trade like stocks, now trade in units of 100, but you can do oddball amounts, and they're called odd lot trading. They are now traded in pennies. Didn't used to be. One time it used to be in eighths and sixteenths and so on, but now they're pennies, and the value is 1 per 1. 100 shares at $2 cost you $200. They now settle in 1 day, meaning the funds become available, or you got to have the funds up in 1 day. It used to be a 2-day rule. You have to put up anywhere between 50 to 90, of course 100%, and you can borrow likewise from 10 to 50%. You have to pay interest on that. You can use limit, stop, and short orders. We'll look at that later. Symbols for the New York Stock Exchange and the American Stock Exchange typically are 1 to 3 letters. On the NASDAQ over-the-counter are 4, sometimes 5 letters. Preferred securities and warrants have their own special proprietary symbols. Bonds, corporate bonds, and government bonds typically are having a face value of $1,000 for corporates and $10,000 for governments, but that's not always the case. It is always the case that they are traded, quoted, priced, transacted as percentage points of face value, which of course is always 100. The corporate bonds are priced in 1/8. The government bonds are typically priced in 1/32. The value thus for a corporate bond having typically a $1,000 face would be 10 times 1.1%. $1,000 is $10. For a government bond, typically priced at $10,000 face, 1 point would be $100, 1% of 10,000. It should be noted that here there is something called a basis point. A basis point is 1% of 1%. So 1% of 1% for a government bond is $1. Settlement for corporate bonds is 1 day like common stocks, and if you're buying, you do pay interim interest. You receive it likewise if you're selling. Do note in the case of corporate bonds, it's on a 360-day year computed in monthly increments. Thus, the 31st, if it is extant, is skipped, and in the case of February, you may get a 1 or 2 day payment at the end. For corporate bonds, you can borrow up to 65%, having a minimum put up of 35%, and you can use those limit and stop and short orders that we will look at again later. In the case of government bonds, the rules do vary, and do note there's a difference between a government bond, which pays interest, and a treasury bill, which does not, and a treasury bill is a pure discount instrument paying no interest. Mutual funds, which are groups or portfolios of securities which can be actively managed or passively indexed with a preference for the latter, and have a 5-letter symbol ending in X, and money markets end in XX. Money markets have typically a fixed price dollar value and are meant as a short-term place to park funds. For a while during the 2007-2008 crisis, they were temporarily FDIC insured, but as that is no longer the case. They typically trade in units of 1,000ths, and you buy them in dollars because you don't know how many units it's going to be because it'll be executed at the end of the day price. You sell them, however, in units. The value is 1-to-1, and they settle on a one-day basis. You can borrow up to 50% on those. Note, you have no ability to use stop, limit, or short orders. Options, which differ from future contracts in that options have the right but not the obligation to either buy or sell the underlying security, are similar to but not quite the same thing as warrants. Warrants being issued by corporations with their own set of rules and specifications. Options, on the other hand, are standardized. Each option is worth 100 shares, so the pricing, while per share, is times 100. They trade in nickels, typically below $3, and above $3 in dimes. Index ETFs, on the other hand, typically trade in pennies below $3 and in nickels above $3. They all settle immediately on the same day, meaning funds are immediately available or required. There is no borrowing. It's all cash. In terms of limit and stop and short orders, you can use those. The symbol notation is a little bit complex, differs from broker to broker. I've shown these here. The broker has something called a chain series where they create it for you and just click on it and you're ready to go. I should note here, with a further explanation done in another video, is that you can buy and sell these calls and puts, a call being the right to buy a security, a put being the right to sell them. Well, that cash settlement's the case of buying either. If you are selling them, you either have to have the security in the case of a call or not. That's calling going naked. Wow. Or in the case of a put, you have to have the cash available. In either case, you've got to put up funds of at least 30%, and there's no interest. One places orders for securities always first with an open. It creates the position. You terminate that by closing it, and the action must be the opposite from the first one on the open. If you buy it, then you must sell it, or in the case of going short, hoping the price drops instead, you first open with a sell and then close with a buy. The price may be a market order, takes whatever's out there. That would be the highest bid if you're selling, the lowest ask if you're buying. In the case of a limit order, that's at or better. In the case of buying, that's below. In the case of selling, that's above. A stop order is the opposite. It's a price you pay a premium, so to speak, to get out of a burning building or to cut in front of the line. It comes from an original idea that you, in the case of a closed position, are stopping the losses. There's a fill or kill for non-exchange traded securities, wherein you just see if there's an order out there. Those mutual funds don't have that specification. They are executed on close. Next, you have a time limit specification, which is either day order or good till canceled, which for most brokers is actually 60 days. These first four categories or columns are mandatory. The fifth one is an optional restriction. It's a quantity, and the quantity can be a minimum, less than the entire amount, or all or none for the entire amount. This is particularly useful for bond trading, where if you've got a partial fill, the transaction charge could be greater than the interest payment. Typical transaction charge for bonds is 0.5%. To summarize stop and limit orders, here's a graphical presentation. And if you're buying, you'd like to buy at a lower price. If you're selling, you would like to do so at a higher price, regardless of whether you're going long or short. Again, long, you open with a buy, you sell with a close. Short position, you open with a sell, close with a buy. Both of those would be profitable. On the other hand, in both the long and short positions, you would buy with a stop at an uglier price, and in case of a short position, you would likewise sell at an uglier price using a stop. My mnemonic here is limit orders, you love them, LL. And in case of a stop, I bet you can come up with your own mnemonic for the letter S.